to welcome to CAC this week a new faculty member at the college, Edson Timana, in economics. And Edson's title today is The Current State of the United States Economy. Edson, thank you for putting together this presentation for us.
Thank you. As he said, my name is Edson Timana. I'm a new faculty member here at Lone Star Montgomery campus. We'll talk a little bit about my academic experience, my work experience, and what this presentation will be about. First of all, I graduated with bachelor's in economics and master's degree in financial economics. And after I received my graduate degree, I started working for an international nonprofit organization. We built 11 schools in Haiti, and I was in charge of managing the funds, because a lot of the funds that we were receiving at that time were private donations. So in 2010, I managed about $4 million. Then once the money ran out, I was given a federal grant to manage. This time it was a $1.2 million federal grant for 3 years. With the purpose of training Colombian refugees in South America. So I was down in Ecuador, Panama, Costa Rica, and Venezuela, which is not very friendly to the U.S. as I came to find out especially when Chavez was alive. So we were training Colombian refugees down there, and now I'm teaching economics here at Lone Star College. So that's my academic and a little bit of my work experience. This presentation is about the current state of the U.S. economy. So there's a lot of things that are happening in the long term, right? For example, we have a huge number of people that are going to be retiring soon, right, in the next couple of years. But that will still be a long-term transition that we're going to be making. Right? Not every baby boomer is retiring tomorrow, right? You're going to have a transition. So this presentation is not going to focus on the long-term things that are happening in our economy, but it's going to focus more on the short-term things that are happening in the economy. So let me begin with the good news. There always has to be good news, right? So the good news is that the official unemployment rate is going down, and this, of course, is a bit of a controversial thing to say, just because in the news there has been a lot of talk about wage rigidity and the fact that wages are not going up, and you also have a lot of people that are dropping out of the labor force, right? But if you look at the official statistics, it shows that it's going down, so that's a sign of good news. Now, when I talk about the unemployment rate, what a lot of people like to do is that they like to bring other economic indicators that measure unemployment. So, for example, the big complaint with the official unemployment rate is that it doesn't count employees that are working part-time unwillingly. So if you're working part-time because you need to work part-time, you cannot find a full-time job. It just assumes that you're working part-time because you want to. And that's not always the case, as we know in our economy. So a better measurement of unemployment would be another economic indicator that takes that into account, and that's called the U6. They actually have the U3 and the U6. And the U6, at least for most economists, is seen as a more realistic way to view the number of people that are unemployed. So if we look at that number since the recession, the shaded area shows the recession, is also trending down. So the good news, I guess, is that not taking into account the lack of increasing wages, and not taking into account the fact that there's a lot of people that are dropping out of the labor force. If you don't take that into account, we do see that the unemployment rate is going down. I think that's good news. However, I'll also say about this that a lot of that this data in particularly is 6 months behind, and that's because this is official data that comes from the Department of Labor, it takes them a very long time to come up with this data. It's not easy to come up with these numbers. So we have to. So when we're looking at the short term, we have to take into account what the time difference and what's been happening. So we can safely say that 6 months ago the unemployment rate was coming down. Does that mean that that trend will continue? Well, if everything goes right, then sure. But if everything doesn't go right, then maybe not. And that's really what this presentation is about. So if we look at this graph, and the trend goes, the same trend happened in 2013 and 14. So if we look at this graph, you can see the growth in terms in the growth in jobs, right? In each industry. What this shows obviously is that the growth in oil and gas employment outpaces the rest of the economy. Now, whenever I present this to a lot of folks, they seem to think that I'm interested in the well-being of oil companies, and that is not true. The reason why I'm showing this graph is to show is to show the number of jobs, right, or the pace at which the oil and gas industry has been creating jobs. So if we look at the entire economy, and we care about more people getting employed, right? And I'm not talking about people getting employed and getting paid $1 million like they do in the IT industry. I'm talking about a whole number of people getting paid wages that will allow them to spend some of that money, right, as a whole, right? Because if one person, let's say, makes $1 million in the IT industry, but you have everyone else that's unemployed, it doesn't really that by itself doesn't really do a lot for the economy. But if we have maybe 20 people that are making $60,000 a year, then that does more for the economy, right? So when I looked at this graph, I thought about all the jobs in the oil and gas industry that have been created in North Dakota, along the Rust Belt, especially in Ohio. There's a lot of gas pockets in Pennsylvania, right? So if you add all those jobs that are being created, then yes, the oil and gas industry would outpace other industries. That, of course, doesn't mean that other industries are not recovering, right? You can see here that these that all non-farm industries are also going up, but they're not going up as quickly as we would want them to recover. Which is why I think that this graph is important. Now, what's going to happen? What's happening now, and what's going to happen in the future? I think that given the fact that we have been relying on oil and gas jobs for our recovery, I think that's more worrisome than anything else, right? Because as we've seen, the price of oil has been going down, right? And so far we've seen that lately, right? This was on the beginning of March, but lately it's gone back to $50 a barrel. But from where it was before, it has gone down. So when we look at what's happening in the economy right now, we have to look at the trend, right? So you can't just say, well, the price of oil is going up, so therefore we have nothing to worry about. Well, that wouldn't be a correct assessment, because there has been a huge number of people that have already been laid off because there has been a decline in oil prices. So you have to take that into account before you even start to think about an increase in the price of oil in the foreseeable future, right? So if we take a look at what's at the effects that we're dealing with right now, we're really dealing with all those people that have been laid off that are going into other industries, right? So if you were laid off because and you went to another state, right, or you're looking for another job, or you have a skill that's in demand, then you would be considered to be frictionally unemployed. That takes some time for you to find another state or another job for you to work in. So then we look at the severity of declining oil prices and what that has on oil drilling, right? And again, I'm concerned with this not because of what it does to oil companies, but because it really determines how many people they're going to employ. So we can see here that if oil was above $75 a barrel, we would be looking for oil in the Arctic, but at $41 a barrel, then we're only really, then it's really only profitable to look for oil in onshore Middle East an offshore shelf and maybe some heavy oil. But then you cut all of the profitability of all of these other possibilities of looking for oil, which is why it would make sense, right, if you're not going to drill anymore, if you're not going to look for oil anymore, for oil companies to lay off so many people because it's not profitable for them to keep looking for all of this for all of this oil, right, until oil prices come up, right, for a considerable time. So then here we see the beginning effect of all of these people getting laid off. So here we see a graph of all employees mining and logging in oil and gas extraction, and as you can see, they were beginning to go down, and I suspect they're going to keep going down, right? And again, I'm presenting this not because I'm worried about oil companies, but because we were counting on those jobs to sustain our recovery, right? So you can see that, and this is where this presentation becomes more of a projection because we're trying to figure out at least what's going to happen in the future. How will this affect us? What economic indicators should we also be taking a look at to see how severe this whole thing will be, right? So if we look at consumer sentiment, right? So that's and there's various surveys that are taken around the country. This survey, I believe, was taken from the University of Wisconsin that comes up with quarterly data on consumer sentiment. But we can already see, right, that at the beginning of 2015, consumer sentiment was down, and it tends to go up and down. But the point of me showing you this is really to use this as a projection of how people might feel in the future. So you can certainly imagine that if you or your neighbor got laid off, you know, and because the price of oil went down, then you might not be cheery about the economy, right? You might have a lower consumer sentiment, and this is again a beginning reason to worry, because even though we see a very short-term downward shift here, if people continue to get laid off, then this will go lower and lower, right? So and that impacts savings, right? When people get scared, they don't spend, and when they don't spend, they save, right? So you have to do something with your disposable income, and of course we saw a huge increase in the personal savings rate. And I was also surprised when I saw this because it's seasonally adjusted, so it's taking into account all the fact that more people spend during the Christmas season and not many people save. But even with that, even taking that into account, it's going up. So that to me tells me that there's a lot of people out there that are scared, that they're saving. And if we look at the long-term trend, here we see that there's a negative correlation between consumer sentiment and personal savings rate. Basically, when people are scared, they tend to save more. And saving more is bad for the economy because 70% of our economy is based on consumption. So if you have all these people that are saving and they're not consuming, then consumption goes down. When consumption goes down, private investment goes down. Investment goes down, that drags down GDP and more importantly, future GDP, right, which creates a downward spiral. My other concern is the dollar. As you may know, right, the price of the dollar against other major currencies has been going up, right, and this, of course, will affect our net exports, meaning that because our dollar is worth more, our goods are now more expensive for foreigners to buy, and that would hurt our exports, but help our imports, right? But if we're looking at the current state of the U.S. economy, we don't really. The fact that we're buying more goods from abroad doesn't really do anything, at least in the short term, for our economy. But the fact that we're exporting less is very detrimental to our economy. And I would say that in the case of Texas, it's not so detrimental just because we use most of our ports to import products as opposed to export products, right? But in places where they actually make, where they count on making American products, and they count on shipping those products abroad, such as Tennessee or Ohio or Detroit, right? Then this is a big problem. And lately it's been going down, but depending on how this unfolds, it may be very detrimental if it keeps going up, or in the short term, it could already have done enough damage to hurt these industries, and that's my concern in the short term. Now, net exports as a whole, right, have been going down. I mean, for I believe the last 20, 30 years. So it's no surprise that it's going down. But if we look at the short-term scenario, the fact that the dollar is going up, right, would affect our net exports. And of course, we can see here a very short-term graph of what's been happening to our net exports. And of course, they've been going down. And I foresee that the trend is going to continue for this to go down. Lending, and this is I think one of the biggest things that I'm worried about when it comes to the economy, because as we all know, during the financial crisis, there was a lot of money that was assumed that was going to go into the market, and we assumed that once this money went into the market, there was going to be a huge amount of demand for products and services, given that interest rates were low, and given all the companies that we've saved. And that will lead to more lending and more business, which will lead to more productivity. Right? Unfortunately, what I'm seeing now is that banks are not really lending a lot of money, and they are holding on to these excess reserves. And a lot of economists give a lot of reasons as to why that's happening. In my personal and controversial opinion, I think that that's happening because banks are not being allowed to lend or to take as much risk as they were before. So, for example, we have stress tests on banks. We have laws that are constantly changing. So, if you're a bank that's receiving all of these deposits, you might want to hold on. Your incentive as a rational agent might be to want to hold on to more lending, to more of these deposits than you usually would, because you're worried about passing stress tests or passing other regulations that might be imposed on you in the future, right? So, but whether I'm right or not, fact is that banks are holding excess reserves. Now we see here that at the end, right, of 2015. Right, we went down and went up and went down again. So I'm hoping that hopefully this will go down, which will mean that banks are starting to lend. But so far we can't really say that for sure. That spike there could just be similar to the spikes that we saw here, right, or that we saw before that. And even more worrisome here, we can see that since 2010, right, lending went up. But then it sort of escalated, and then now it's starting to trend down. And I think that given the amount of money that we have tried to put into the system, and given the amount of bailouts that we have tried to put into the system, you would think that more commercial and industrial loans would be made. Right? If there's really a strong recovery, if banks are greedy, if everyone is trying to make more money, we see a positive outlook in the future, then you would think that commercial industrial loans will be up, right? But as you can see, I mean, at best, that they're sort of maintaining at the 5% level, and they're not really going up, right? So I think that's another reason concern. Now, early warning signs of what's going on, and again, this is a projection, but what I was interested in taking a look at is looking at some type of economic indicator that will tell us if people are spending in things that they don't need to spend, right? So, for example, clothing is one thing that we all can, in the short term, do without. We don't need to go out there and buy a new pair of shoes every single week, right? If we're saving more, right, and then we can use the same pair of shoes. But so as an early warning sign, I would look at the retail sales and whether that's going up and down, and we'll use that as a signal to see if people are spending or not. And as we can see here, retail sales adjusted for the December season are down, right? Which correlates with people increasing their savings, consumer sentiment going down, banks not lending, the dollar being where it is right now, and having all these people get laid off because the price of oil has been declining. So if this trend continues, I'm not going to say that we're going to have a recession. I think that's unlikely. But my point with showing you all of this is to say that the economy is not as strong as a lot of people think that it is, and that if things and that if something's not done about it, or if another industry doesn't pick up and hire all these people, then we might have an even slower recovery. Okay, that's as far as I'm going. Slow recovery. I'm not saying that we're going to have a recession or a financial crisis. I'm just going to say that this will most likely make Janet Yellen, the chair of the Federal Reserve, rethink as to whether she should increase interest rates in June, right? And since I'm on camera, I'm going to predict that she's not going to. So those are my sources in case anybody wants to check my work. And thank you.
Thank you. So any questions, comments?
Yeah.
I was always very curious about this huge, the debt, state debt of the United States, which is currently more than 18 trillion. I still don't understand it well, because some people say this is even good, some people say that that's okay, some people say this is horrible, catastrophic. Can you enlighten us with what is actually, and all issues related? What should we expect? Is it okay or not okay?
Right. Well, again, my opinion. This is not the opinion of Lone Star College or the business department of Rationalism. But in my opinion, debt in and of itself is not bad, right? I mean, I still think that if you take a loan to go to college in a field that's in demand, then you can actually come up with a very good rate of return. So it wouldn't necessarily be a bad decision. Now, if you misuse that money, then that's when it becomes a bad decision, right? So I'm not really worried about the debt per se, even though it's really equal to, or yeah, it's really. The last time that I heard it was about 90% of our GDP, right? So 90% of about $15 trillion. So I wouldn't be concerned too much about that. What worries me really is how that is being used, and how whenever we seem to have a recovery, or whenever we have a real recovery, whenever the economy is strong, nobody really goes out and says, well, since the economy is doing that well, then maybe we should think about maybe reducing our debt levels, and maybe we should think about paying this or paying that, right? Because that would be the best time to do it, if that was really a long-term concern. But what I saw, at least during the last during the last couple of years, is that at the worst possible time that you could worry about the deficit, that's when we worried about the deficit, and we closed down the government, and that made us and we redid all of our budgets, which put a lot of people out of work, especially people that were training Colombian refugees down in South America. So I would be against doing that. Do I think that we should worry about it too much? Well, in the short term, no, right? I mean, in the short term, you have countries like Japan that have 3 times its GDP level, right? That they're indebted three times. Also, the level of GDP who are we lending this money to, or does that even make a difference? But I think that in the short term, our real concern should be really geared towards the skills, right, that we're allowing people to attain, in the feasibility, right, that's there. I think that's going to be the real challenge, and I think that if there's so much demand, and that we have such a strong recovery because our skills are so valuable for the rest of the world, then I think that would drive GDP way up, and at that point we wouldn't care too much about paying taxes or lowering the debt, right? Because at that point we would have enough money to do this. It's only when we're in a situation like this that we worry about this. Yeah.
What would be the economic benefit of having an inclusion policy for all the shadow population here? And the undocumented population, what would be the economic benefit or
Right, but I mean, what do you mean by inclusion policy? You
know,
mean bringing them into?
There's a shadow population.
Right.
It's undocumented, and if we had the government somehow have an inclusion policy
Right.
and sort of heal the border and heal the immigration system, what would be would there be a plus to that? If we did nothing, is there going to be a negative? What's going on there?
Right. Well, in my opinion, I think that we already have, as you stated, this shadow population that's existing in our economy. Now, for official purposes, we cannot count them, right? So technically, they would go under the underground economy. So if we bring them out of the shadows, I think that would positively add to our economy. But I think that just bringing them into the official economy would not be as great if we do not allow this population to train themselves, because the value is really in the training. If we just bring them in and we don't provide facilities for them to train themselves, then I think that you could even have a situation where there would be a loss or a burden on the economy. But it's only if we can allow them to produce a certain value that's when they would become an asset.
So any inclusion policy should include things like learning English, job training, getting accounts, having protection of the law, minimum wage, maybe some sort of a empowerment vehicle.
Right. Then we get into the minimum wage, right? Because that's something that's a very controversial issue that I choose most of the time not to talk about in my classes, or what I do is that I present both sides to make it fair. But in my opinion, if you're going to do something like that, then you have to, if you're going to bring people out of the shadows, then you have to allow for them to be able to produce some sort of value. And placing a price floor on that would not allow a lot of them to produce value in our society. So we would end up with a lot of unemployed individuals, which would become a burden.
I was struck by the phrase rational agent that you used, a bank as a rational agent.
Right.
And yet, you also brought up some examples in recent economic history which don't seem to be the most rational moves, right?
Right.
So, ultimately, are you suggesting that economics is a rationalist enterprise, or that, let me rephrase that economics charts rational behavior or non-rational behavior?
No. I strongly believe that it supports rational behavior. And notice that you said that it seems that banks are irrational. And from a bird's eye view, I would agree. It seems that they are irrational, right? So if we talk, for example, about the real estate bubble, I mean that was something that, or even the financial crisis. I mean that to me really started back in the early '90s with the Glass-Steagall Act, and the fact that before that you had to choose between whether you wanted to be a bank or a financial institution, and we did that after the Great Depression to prevent to prevent future financial crises. But it was Alan Greenspan that advocated to get rid of the Glass-Steagall Act with other politicians. And once we did that in the '90s, I don't think anybody thought that this would happen, because the idea, and I remember reading articles at the time where Alan Greenspan would say that the Glass-Steagall Act was outdated and that it wasn't part of the way that we ran our economy today, and that we would only allow more banks to sell, or financial institutions to sell more financial products, then more people could afford homes and get loans and attain the American dream. Right? And there was a lot of politics and propaganda attached to this. So if you assume that banks are a firm and that firms are going to try to maximize their profits, then it's perfectly rational for these institutions to come up with, if they're allowed to come up with all different types of products to try to maximize their profits, which is exactly what they did. But it wasn't until we allowed them to do that. And now after we have this crash, we sort of want to put the genie back in the bottle. I think it's politically too late.
One other comment on shadow things.
Yes.
Do you think there's a hazard in the financial markets of dark pools?
I have my opinion. I think that when it comes to trading and dark pools, and this also goes with high frequency trading, I think that there's a lot of things that you can do in the short term, and economics will tell us that in the short term you can manipulate a market. You can actually manipulate a market very efficiently. I mean, I teach my students how to take over a country, exploit people economically. These are all things that have happened in the past. Create your own monopoly, but in the long term, you really can't get away from value. So in the long term, what seems to happen is that you have that you have a tendency towards equilibrium. So if you want to take over your life savings and look at charts that may or not mean much, then I think that you should have the freedom to do it. But as a long-term financial goal, I don't think that people should be doing that at all. I think that people should be long-term investors.
I'm just concerned because men's inventions about like special purpose entities and derivatives and all this
Right.
have precipitated two crises. And I'm trying to figure out what the next thing on the horizon is. I'm
Right,
concerned
but
about
I
market
wouldn't say that it's these these products necessarily, right? Because these products, after all, allow us to they're really money creators, right? They allow us to increase our liquidity, to take that, and they allow individuals to take on more loans for businesses to produce value that we all profit from. So I don't think that those tools are bad in and of themselves. I just think that you have to set up things so that you have the same number of people working with the same amount of information. And what happens, and I think what happened during the financial crisis, is that a lot of people didn't know what they were getting themselves into. They took out a mortgage and they didn't know the severity of how that mortgage worked. You had people that were working in the financial industries that didn't have a background in finance or economics. So, or you had people that, for example, had, I remember vividly how there was a lot of people that were getting hired from Ivy League schools, but they didn't have any of this background, so they didn't understand the severity. And what these financial firms did was that they would hire one economist for every number of other employees that they would have. And the economists would sort of have to see where things are going. So I think that when it comes to our financial well-being, we have to take into account whose analysis we rely on. I think we have to take that more seriously, and which is why I'm glad that the Chartered Financial Analyst, right, or the CFA institution, has taken it upon itself to establish a financial standard, and that basically says and it's a global standard. So whoever is able to pass those tests and get the number of years of experience that they are able to attain, that basically tells the world, okay, this person has enough expertise to trust what this person is saying. Unfortunately, for the CFA Institute, there's only 120,000 CFAs in the world, which is very little, which is really not enough compared to the number of CFAs that we need to uncover. Yeah.
There was a lot of greed involved in the last financial crisis as well. People making loans they shouldn't have been making. So I think the charts like Dr. Hickerman were talking about, rationalization charts don't always take into account greed and what people do on a personal level. And if, like you said, I think some of the regulations were relaxed so certain people could take advantage of certain things and make loans they shouldn't have been making. People were flipping houses. Everyone was looking for short-term profit as opposed to looking at the long term.
Right, exactly. But I mean, when you talk about greed, I mean that in and of itself, I think is not always well used, because especially during the financial crisis. I mean, if you would have known, if you would have truly understood what you were getting yourself into and what you were buying and what was going on, then maybe you wouldn't have. Then maybe a lot of the traders wouldn't have done what they did. But because there was a lot of people that didn't understand what was going on, then that's why these things happen. And you had countries that refused to trade a lot of these products. For example, Chile refused to take a lot of their the money that they had set aside for their people's retirement and invested in all sorts of financial products that they said they didn't understand, and they thought to themselves, well, if I don't understand this product, I shouldn't be investing in it. And when the financial crisis happened, they turned out that they had made a good decision. So I think again, it comes down to understanding these products, not investing where you don't understand, and just investing in the long term. Because in the short term, of course, a lot of things can happen. In the short term, you can manipulate a market very easily. But in the long term, you really can't.
Don't you think the U.S. is overall has tended to have a short-term thought process, short-term profits for the last 20 years, as opposed to Japan? Maybe someone like Japan, who looks at more long-term,
Right.
will invest in technology that's good, maybe won't produce anything right now, but 20 years down the road.
Mm-hmm.
We have a lot of companies that won't profit now. So in the oil industry is a profit now industry. And do you think the lower oil prices maybe give us the opportunity to maybe, usually when you have lower energy costs, it helps other industries. The cost of transporting goods is lower, the cost of manufacturing goes down a little bit. But then you have companies that intervene, like the refineries, they lower their production to keep the gas prices from falling too far, so they manipulate the market. So.
Yeah, and I mean, I think that in the long term, the market is going to understand what's been going on, and the market is going to learn from its mistakes. I mean, after what happened in the 2008 financial crisis, or with oil prices right now, I don't think anybody that has seen that in the news would go out there and say and take their savings and put it in the stock market, start to day trade, or open up a small oil company, right? Or you have these big oil companies that have now taken that into account in their models. So the major oil companies are not going to go out of business, right? They're doing just fine. We can see that with the profits. But if you look at smaller companies that are not looking in the long term, then you see that there's a lot of bad decisions being made, whether it's driven by greed or misunderstanding. I mean, yeah.
What is the outlook on oil prices?
That's when we get into microeconomics. Okay, and if you have monopolistic competition, right? So if you have a couple of players, a handful of players controlling most of the market, which is I think what we have now, right? We have Saudi Arabia, America, Russia, a lot of OPEC or non-OPEC countries controlling the market. Then what usually happens is that if there's in the short term there's a race to the bottom, which is what we've seen, right? A race to the bottom whenever new players try to come in. But that race to the bottom comes at a cost of profits, right? So a lot of countries, right? Saudi Arabia, for instance, they haven't been making as much money as they would have hoped.
But they announced today that they raised the production to
Right.
11.3.
That's where I was going.
Yeah.
That's where I was going at. Because once you're able to lower the price to drive other competitors out of business, then you're left with the original players, right? Which then the rational thing to do would be for the price leader, in this case it would be Saudi Arabia, to increase its price, but not by a lot. It would just have to be just enough for it to recover its profits. Because if it raises the price by $10, $15, then they would invite all of these other players back into the market, which is why, right, you see such a short-term increase, which in microeconomics it perfectly makes sense that they would do that. And as they start to create more profits, right? We have Iran, right? That if everything stays the same, we'll start to export oil, but they are only a small percentage of the market. And now you have these American companies that are going to be more careful as to whether to start oil companies. So, yeah.
Let me understand this. So you're saying that Saudis are increasing the production today, what they announced, to further push the other sellers out? Is that what you're saying?
No, I'm saying that has already happened. That because that has already happened, because all these small oil companies around the world have basically gone out of business, that gives the price leader, in this case it would be Saudi Arabia, a chance to go back and increase the price, not by a lot, but by a little bit, and which would make all of the other major players start to increase the price again. But you have to look at who's the price leader. In this case, it would be Saudi Arabia.
In other words, they want the price to increase a little bit, but they want to keep it at that spot long enough so these smaller companies won't come back. They want to permanently push them out of the market if they can.
Yeah.
So how long do you think, and I've heard economists say they may want to do this for a couple of years to keep, push these players out of the market.
Right. How long do you want to keep them out of the market? That I am. At least I would say at least a couple of years, right, to discourage them.
Do you think if the price goes back up that these companies will be able to come back into the market, or do you think this is a plan that Saudi Arabia thinks that they won't be able to come back in if they keep it down long enough that they won't?
That's hard to tell, right? Because you're looking at different cost structures, right? As you saw from the graph, right? It really depends. It's really a question of how much does it come back up. But Saudi Arabia, as a price leader, always has the option of lowering the price again, right? So if they see that too many players are coming in, they can always go back and lower the price, which would influence us to lower, or every other player to lower the price again. But that's also assuming that you have enough demand to sustain these prices, right? So you can have a monopoly on anything, but if there's not enough demand to sustain your profits, then you're not going to leave it.
I like the term you used, market equilibrium, which economists like, and they, and some people may not be familiar with it, but in the market, it tends to level out in certain ways.
Right.
Certain things happen, whether it's supply affecting demand or demand affecting supply.
Yeah.
What do you think? Saudi Arabia's long-term goal is with this flooding the market?
I think what's most important for them is to keep the percentage of their market share stable. As long as they can keep the percentage of the market share stable, they will always be the price leader. They will always have a big influence in the market, and that will maximize their economic profits, not their accounting profits. So the big difference, right, is that with economic profits, you're taking into account opportunity costs. So what else they could be doing with their resources. So as long as they maintain an economic profit, which is possible to maintain if you are the price leader under a monopolistic, under a competitive monopoly, then they're going to be able to rely on that stream of income coming in. So I think that's what's most important.
You've outlined a lot of stress factors
Mhm.
facing this. How much of these things are going to give the markets a feeling of uncertainty, and how much of this are we able to cope with pretty well?
Well, I think that the market is already adjusting historically, and I have data to prove this. The stock market is not going to do as well in the next 4 years as well as it has done in the last 4 years. Now, there's a lot of economists that are coming out and saying the stock market is going to crash. I personally don't believe that, but I do have historical data that proves that it's not going, statistically, right, that it's most likely not going to yield as good as returns as we've seen in the last 4 years. Now, when you talk about the stock market and the economy, there's a big disconnection there, right? So it's not. So the answer is not that clear. I think that we're going to have a very slow recovery, and that we're just and the stock market is going to keep going up, but not by much.
Do you think companies are going to kind of consolidate, streamline, and try to get some of their?
Sure.
If oil's at $100 a barrel, what we're doing is we're taking loans out and doing risky things to get now that ain't happening. So
Right. Well, that's one option. You could consolidate, or you could expand. Right. You could look for other markets, and that's really what I'm really excited about to see in the next coming years, because you have India that's growing, you have other developing countries that have proved that they are not as dependent in developed countries as we thought that they were. They have their own economies, they have their own a very strong population that consumes, they have an emerging middle class. So I think that will open up the gates for a lot of investment in a lot of these countries. But they are right now, if these countries wanted to, well, not India, but for example, a country like Tanzania, right, that's in the very early stages of development. If they wanted to raise money for their own companies, there's a lot of investors that will not invest in the countries such as Tanzania because it's proved to be too risky. But I think that as we go on, we're going to have to really adjust our risk models so that it makes it possible for us to invest in those countries. Because if you, for example, look at a country like Tanzania where it grows 10-20% a year, okay, and then it goes down. Well, if I'm going to invest in that country, then I have to receive a higher return for my investment, right? Because I have to take into account the risk that I'm taking. And if I think that's feasible for me to do, then I should do it, right? So for example, if I'm a 30-year-old, right, and I have to wait until I'm 65 to retire, then it's okay for me to take more risk. But if I'm 63 and I'm going to retire at 65, then I shouldn't take more risk, right? So I think that as we see developing countries emerge and attain more money, you're going to see them have more investors.
The low energy prices and strong dollar may help that.
Well, it makes in a sense. I mean, it doesn't help them with our products, right? It makes our products more expensive, but they may look for other substitutes. So they may try to, maybe at that point it will become cost effective for them to produce their own products. But that's assuming political stability and all those other things.
This was about short-term outlook for the economy. What do most economists feel is the long-term outlook for the American economy?
Right. If it depends who you ask, but at least the people that I read, Peter Schiff, Ben Bernanke, Alan Greenspan, I mean, all the chairs, Paul Krugman, people in academia, Rubini, they would all say that the long-term outlook is still very, very strong. Right? I mean, you still have a large group of people that are very that for the most part are skilled laborers, right? They may not be highly skilled laborers, but they're still skilled laborers. And you have a vast amount of infrastructure, which makes it a good place to conduct business, assuming that all of the things are okay, right? Assuming that you can have a relatively low tax rate and really good infrastructure, right? So
We also have a system, and we've discussed this in conversation groups with people from other, like Venezuela and Mexico and things like that. The United States has such a good system for foreign investment. The structure, it's receptive to foreign investment, which you don't see in a lot of other countries. People are scared to invest in Mexico or Venezuela right now because their investment could disappear in a moment. But you can come in here. Japan makes most of their cars sold here in the United States now. But we do have an aging population as well, and if we do continue to have investment, I always argue that immigration, even illegal immigration, is not the worst thing if you have a younger group of individuals. If we're going to continue to have less children and our population is going to age, then we need younger workers in the economy. Traditionally, the most robust economies have a large number of younger workers, right?
Right, and that's what we're sort of coming to a predicament with immigrant groups, because historically, when we brought in, when the U.S. has had immigrant groups come in, because there was a lack of infrastructure, because there was a lack of formal structures that didn't really cater to them and they didn't really care to train them. it took a lot of these immigrant groups generations for them to train themselves and to add a lot of value to the economy, right? And once that happened, then they tended to have less children. Then and then a new group of immigrants came in. But what we have now is an economy that, or an economy that, for better or worse, is able, they can to take a young group of immigrants, and within one generation, you're able to have somebody come in that speaks no English, you know, at the age of 5, and by the time that they're 21, you know, they're going to Harvard, they're going to Ivy League school, they're doing something about it. So that in itself, I think, is really going to hurt us population-wise, because we're not going to have the number of children that historically they have had. Just because you see a trend that when you have this higher degree of training, I'm going to call it education, we call it training. These people tend to have less children. So in terms of population, we need to bring in even more people in if we want to have. Or of course, the other silly idea would be not to train, but that's more silly.
Yeah, I've heard that a lot of European countries actually encourage or even pay for immigration now because they're having a shortage of workers. Like you said, they're well trained. For instance, maybe Germany or somewhere like that, where they become well trained and they're having less children. They run into problems meeting their, getting the labor they need. But Germany also, in another way, has a system of training. I think that we can learn a lot from.
And that's the key. I think training is really.
We have the resources, the infrastructure, the colleges, everything's here.
Oh, it's cool.
Yeah, it's all here. It just,
It's a matter of will, political will.
Political will, but not only have inclusion, but to also have some path for everybody to get the skills to try to improve economic life. Yeah.
I agree.
Well, thank you.
Yeah.